Do you want to know why you always lose in the stock market? That's because you are loss-averse, herd-driven, and overconfident. Simple and concise, right? Want to know the reasons in more detail? Then stay tuned. A video explaining everything follows right now.
Have you ever looked at your portfolio and wondered, why did I do that? Maybe you held onto a plummeting stock, hoping it would bounce back, only to watch it hit zero. Or maybe you jumped into a hype train way too late because everyone else was doing it. If you have, you aren't alone. And more importantly, you aren't necessarily irrational, at least not in the way we used to think. You are human. Today, we are going to answer 4 of the biggest questions in investing. But we aren't going to use charts or technical analysis. We are going to use behavioural economics. We've come through doctoral research to explain exactly why your brain makes these decisions. Question 1. The disposition effect. Let's start with the most painful one. Why do we hold on to losing stocks for too long? In finance, this is called the disposition effect. It is the tendency of investors to hold losing investments too long and sell winning investments too soon. But why do we do it? Research points to a few psychological triggers. The first is prospect theory. Standard economics assumes we value wealth in absolute terms. But behavioural economics shows that we actually value things based on gains and losses relative to a specific reference point, usually the price we bought the stock at. Here is the kicker. We feel losses much more intensely than we feel gains. In fact, research suggests that for many people, the pain of a loss is significantly greater, often estimated as 2 times stronger than the pleasure of an equivalent gain. Because of this loss aversion, when a stock is down, you enter a psychological danger zone. You become risk-seeking in the domain of losses. You'd rather gamble on the chance that the stock breaks even than accept the sure loss. But there is a second layer to this called realization utility. This theory suggests that investors derive utility, or happiness, literally from the act of realizing gains and losses. As long as you hold that losing stock, the loss is just on paper. The moment you sell, you crystallize that loss. You have to admit that you were wrong. Selling a loser creates a burst of negative utility. It hurts. By holding on, you delay that pain. Conversely, selling a winner gives you an immediate burst of pride, which is why we sell winners too early. So, you hold the loser because your brain is trying to avoid the realization of failure. Question 2. Herding. Question number 2. Why do I buy stocks when everyone else is buying, even if it might not be the best decision? This is herd mentality. Behavioral research suggests that people like to do what most people think is right to do. One driver is information cascades. This happens when individuals disregard their own private information. Maybe you read a report saying the stock is overvalued, and instead follow the actions of the crowd. You assume the crowd knows something you don't. But recent research adds a fascinating emotional layer called social comparison. Specifically, something called behind-averse social comparison. We experience distinct disutility, unhappiness, if we have a worse outcome than our peers. If everyone you know buys a stock and it goes up, and you didn't buy it, you feel behind. In a behind-averse environment, this fear of falling behind creates a bandwagon effect. Even if you think the stock is risky, the social cost of being the only one who missed out is psychologically heavier than the financial risk of buying in. You herd to protect your social standing. Question 3. Overconfidence. Question 3. Why do I get overconfident after a few good trades and start taking bigger risks? This comes down to something called ego utility. Traditional economics assumes we only care about money. But behavioral models suggest we also derive utility from positive views about our own abilities. We want to believe we are smart and capable. When you make a trade, you aren't just betting on a stock, you are learning about your own talent. If you succeed, your ego gets a boost. Research shows that once people form a positive belief about their skill, I'm a trading genius, they often stop acquiring new information to protect that self-image. Basically, if you think you've figured it out, you stop checking to see if you might be wrong, because finding out you were just lucky would hurt your ego. This leads to overconfidence in your beliefs, which translates into overconfidence in your actions, taking bigger risks than you should. Additionally, there is the self-attribution bias. We tend to attribute success to our own skill and failure to bad luck. If you win, it's because you're a genius. If you lose, it's the Fed's fault. This feedback loop inflates your confidence, leading to aggressive trading. Question 4. Regret. Finally, question 4. Why do I keep regretting past decisions even when I can't change them? This is the domain of regret theory. This theory proposes that people experience unhappiness not just from the outcome they got, but from comparing it to the outcome they could have had if they had chosen differently. It's called counterfactual thinking. You aren't just looking at your bank account. You are looking at the imaginary bank account you'd have if you had bought Tesla 5 years ago. There is a specific type of regret called backward-looking regret. This is closely tied to the sunk cost fallacy. People have a tendency to refuse to accept sunk costs, money that is already gone, because accepting it forces them to admit a mistake. Research shows that abandoning a bad investment involves admitting a wrong decision was made. This reveals negative information about your own skills. To avoid that blow to your self-image, you might obsess over the decision or refuse to close the position, hoping to justify the original choice. You stay trapped in the regret to avoid the finality of admitting failure. Conclusion. Holding losers to avoid pain. Buying with the herd to avoid falling behind. Taking risks to boost our ego. And obsessing over the past to avoid admitting mistakes. These aren't just random errors. They are systematic psychological mechanisms. Understanding them is the first step to conquering them. Thanks for watching.